Good morning, everybody. Welcome to the Flow Show, Thursday, 19th of October. Hope you're all doing well. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Happy anniversary, mate.
Oh, thank you, mate. Thank
20
you.
years already that your wife is putting up with you. I mean, she's an admirable woman.
Yeah, you get less time in prison for murder, but that's another story than 20 years. But no, thank you very much, mate. Thank you very much. Yeah, it's a bit of a milestone, and yeah, testament to her that she's still with me.
Exactly.
Right, anyway, away from that, let's get stuck into things. Over at the Bank of Japan, the BOJ's quarterly report has raised the assessment for 6 of the 9 regions. Broadly, numbers saying that, or broad comments saying that the economy is picking up or recovering moderately for all regions. Many firms said they wanted to look at price developments and rivals' actions when deciding how much to raise wages next year. Many firms expect to keep hiking wages given structural labour shortages. That's music to Kishida's ears, those comments. We've had some comments out of the different branches, a couple of different branches within that report. The Osaka branch manager says the weak yen is beneficial for exporters, but firms with big exposure to overseas markets, beneficial for exporters and firms with big exposure to overseas markets, but it's hitting some sectors via high costs. The impact of the weak yen on profits varies from company to company in the Kansai region. The Nagoya branch manager said it's hard to say with certainty whether wage gains will continue given the economic uncertainties. While we're on the message of wages, we had this earlier this week, but it's been confirmed that Japan's largest labour union, that's Rengo, is aiming for wage hikes of 5% or more in 2024. They're looking at also a base above 3%. So that will be coming in labour talks next spring. That'll be, again, another big boost for Kishida. We've had an ex-BOJ board member out again, Sakurai, saying that negative rates may be scrapped before they tweak the YCC, and the BOJ could end negative rates by year end. These comments aren't new. He spoke back in late September, pretty much saying the same thing, although he had a later date on that. He was saying into the spring, April is when that could happen. So he's brought forward his thoughts on that. Our currency bod Kanda said he won't make any comment when intervening in FX markets. And the Japanese Bankers Association chair said if long-term rates rise significantly from current levels, there could be downside economic pressure and activity. So bit of a warning there for the bankers. Been talking their book anyway. And PM Kishida is apparently going to instruct or get people to consider temporary income tax cuts. So that sounds like, on the, I haven't read the detail, but it sounds like on the face of it, more sort of immediate easing of cost of living pressures over there rather than a big policy, because they're going to be temporary income tax, but we shall see. Kay, what do you make of all that Japanese stuff? Looking a bit warmer on the wage front, isn't it? The snowball on that side of things definitely seems to be rolling.
Yeah, I mean, Rengo has a pretty loud voice in the affairs in Japan. So we shouldn't completely dismiss that. That is for one. Now, if they're going to get it, you already have a partial answer from some of those regions saying that it's not sure it will happen. For the rest, it's all the doors are open now. They've all been they were open and they've all been kicked in again. The regional reports on the economy they are a little bit like the European consumer confidence. Yeah, it's never been positive, or only once in our lifetime. Those European consumer confidence numbers. I mean, the Japanese is the opposite. They're always like muddling on, or expected to do a little bit better. I think I've seen it since I've been trading the yen. So I'm not going to hang my hat on too much on that. On the tax cuts, it's a bit of a double-edged sword, right? If one believes that the economy is going to kick on thanks to that, should in theory be a bit supportive for the yen, and perhaps alleviate a bit of pressure when the weather will continue to normalize. On the other side, Kishida is probably going to pay for it. Well, the government, same as with all the rest. So that means more stimulus, more debt, more whatever you want to imagine, which in turn is not a great factor for the yen. So it's all a bit. Are we going to see major changes here? It's still very much a wait and see game over there, you know.
It sounds like just another subsidy, like the fuel subsidy, just to get people this price pressure hump again.
Yeah, well then
structural tax changes.
Yeah, but we all know that if you lower the income tax in Japan, they're probably going to save more.
Save it. Yeah,
and only a small percentage will go straight into the economy, right? That is the thing in Japan. Well, it has been traditionally so. I thought the new generation may be more spenders, but they don't seem to confirm that idea right now. So yeah, I think we can only be in a wait and see. And really, the big move in Japanese macro will be if and when Ueda decides that it's time to do something about the monetary policy. Really, for the rest, it's a difficult thing to really measure, or for us, at least traders, it's difficult to trade on the back of it. You need to have a strong conviction that the Japanese economy is going to do very well to start buying yen, right? Because for the time being, buying yen is just too expensive.
Yeah, very much so. Very much so. Okay, doke. Well, moving on from that over to the ECB, and a bit of a piece from EconoStream on the ECB. A bit of waffling in this piece, but there's some interesting comments made, particularly at about QT, which is something we've been talking about here. As if the ECB is on pause at their future meetings, what are they going to fill the news with? And it's likely to be QT. And what the reporter did there, he totted up the possible numbers for those in favour, those against. Increasing QT, ending PEPP reinvestments, that sort of thing. He said there's 10 that are clearly probably in favour, 3 that are possibly for it, 4 uncommitted, 3 probably against, and probably 6 clearly against. So in the 4 column, there's potentially 13 governing council members. Against, there's 9, and there's 4 uncommitted, which is probably a fair reflection of how things stand. So the QT question is probably going to be the bigger talking subject at the next ECB than what they do on rates. It's going to be difficult to judge whether it's going to be traded on. QT is increasing. That can be considered a form of tightening, but as we've seen, when all the central banks enter QT, it's not really a bullish move for the currency. We might get a knee-jerk reaction in Eurodollar if they announce something, but I don't think it's going to be anything that's lasting. Trade that event if it happens and forget about it 10 minutes later. You have a different opinion, Kay? Do you think increasing QT is going to be anything worthwhile
in Europe?
Yeah.
The thing is, it depends how much they increase it by. If you compare it to the US, for instance, it's they're far behind, right? US is QTing for somewhere between 60 and 90 billion dollars a month, if I'm correct. ECB stands at about what, 10-15 right now.
Yeah.
What are they going to increase it to? That's the question. It may, have an effect rather euro versus the dollar block on the euro versus other currencies. If we bring it back to what we are watching, and that in turn may perhaps put a bit of a bid under some of those euro crosses if they really go ahead with it. But increasing QT, well, regardless of what they may say, because even Powell is trying to downplay the impact of QT on monetary policy, but it is monetary policy, right? It's pure and plain monetary policy. So if they increase QT, that's, I reckon, is going to have an impact on what we see in the euro, and we could have this kind of effect that what we see on the US yields right now, because I do think those US yields are impacted by QT as well as other factors. And we could see this kind of effect. So de facto put a bid under the euro if they decide to increase. I think we cannot just shrug it off and say that, well, yeah, so be it. No, it's really, it should have an impact.
Yeah, I think also probably yields is probably what we got to watch more closely than the euro in that aspect, because QT in the eurozone is government bonds. In the US, QT is still MBS and that sort of stuff. So there is some subtle differences between it.
The US is a mixed bag. The US is a mixed bag between a lot of things, which is sort of, if you compare it to Europe, I mean, it doesn't have the same names, but it's still sort of the same. Although, I don't think that in ECB's case they are having any corporate bonds or so on.
No, they've got corporate bonds. No, the UK's got corporate bonds. It's mainly government bonds, isn't it?
But I mean, the effect, should be relatively similar, but as you say, perhaps even more direct. Yeah,
because they'll be selling obviously their bonds, and that's going to add more supply or more liquidity into the market. So, we're going to have to wait and see and what the effect on that is. But I think you're right. I think that the size of an increase in QT is going to matter. Then we'll see what effects it has on markets anyway. Right, moving on, look at some of the data from yesterday. Not a lot out, but there was some housing data in the US. NBA, that's been sucky for a long while, and it's continued to be sucky. Has been a bit of a forewarner for the housing market in the past. It's continuing one way only. As you can see, the 30-year mortgage rate ticking up as well. That's a big reflection on yields. I've seen another headline of mortgage rates, can't remember who it was, it just slipped by. The mortgage rates are now up near 8% in some aspects. So there's going to be a bit of a squeeze coming into that housing market. We didn't really see much of that in the starts and permits number. Permits were a bit higher than expected, but still down on last month. Starts missed expectations, but we're up on last month. So bit of a mixed bag in that. No real trend as yet being seen there. Might be a bit laggy to some of the other data we've seen, like that NHAB housing market index we got yesterday, but we'll keep our eyes on it. Anyway, Canada as well, housing starts pretty healthy, 270k. But as I mentioned yesterday, they're just coming out of their winter, so no problem, no doubt. So that's why we're seeing that pick up. Joking, of course. Fed's Waller said it's too soon to tell if more policy rate action is needed. we can wait, watch and see before making definitive moves on the policy path. If we saw inflation coming down to 2.5%, the Taylor rule would say to cut rates. He still has one rate hike pencil in, or the Fed still have one rate hike pencil in, and that will be totally driven by the data if it happens or when. Fed Williams says inflation has come down quite a bit, but still has a way to go before getting inflation back to target, and he's not declaring victory over inflation, although is seeing some progress. Fed's Bowman, inflation also saying, Fed's Bowman, she's also saying inflation has come down, but it is still too high. We've got the Fed's Beige Book out as well, which again is a bit like the Bank of Japan regional assessment thing. The general gist was that the economy saw little to no change since September. Consumer spending was mixed, especially in auto and general retail. Prices continued to increase at a modest pace overall. Labour market tightness continued to ease across the nation. Some banking contacts reported slight to modest loan declines in demand. Consumer credit quality was generally described as stable or healthy, but delinquency rates, although still historically low, were increasing slightly. So all soft landing noises in that report there from the Fed. Onto oil.
By the way,
Yeah, go on, mate.
I'm gonna say, and that's one other example about how fashion change when watching data over time. That beige book, when I recall when I started to work, and then the first like decade or so, that beige book used to be a real market mover.
Yeah,
and
very much so.
Lately it comes at a time where either the US is having their lunch and we are already in the sofa watching football or snooker or whatever, and nobody really seems to care too much about it anymore. But it does paint a state of how the local economies are faring, right? So it's a bit strange, and I just wanted to make a bit of an aside and show how some data come to the fore and then are pushed back into the background. And this one is one that really no one is really looking at right now, or at least not making trading decisions on the back of it. And it's just, I just wanted to highlight that it used to be a very, very important report.
Yeah, very much so. I think it's now because we get so many private reports that are more up to date. We get that insight earlier than the beige book. I mean, I've only started looking at it the last couple of reports just because there were some striking headlines in there. And it's just worth now, because we're looking to see how the data matches up with other bits and pieces and how that's going to affect our trading moving forward, what's happening at central banks. Hence why I'm just keeping an eye on it, just to see if there's any little clues within that that maybe we can pick up that others don't, and it gives us a lead into a trade that maybe we can get in a bit earlier than other people. But I mean, I remember when this was a big number. Not big number, big report. But as I say, all the, because we get so many private reports like the NHAB, the NBA, NFIB, all these little reports. Now we do get that sort of insight already. But before we had all those, this was one that you got a lot of information from. But we'll keep an eye on it. It's just a little bit more work for me, so you don't have to.
It used to be actually, a bit of a. It was equally important to retail sales, like if you compare it, and also it did give like a bit of a state of the economy ahead of what the FOMC may be doing a couple of weeks later, and I just wanted to highlight it, that it used to be a big report. So as you say, it's worth keeping an eye on it, just for comparison to other data that we get.
Yeah, exactly. Right. The only other, we've still got obviously bits and pieces going on in the Middle East, but there was there's been a report OPEC Plus is planning no extraordinary meeting or immediate action. This was after the Iran foreign minister called for an Israeli oil embargo. Bit of a weak pushback, a weak denial. Just because they're planning no extraordinary meeting doesn't mean they may take action or they may not take action. But anyway, it's something for oil traders to take a look at. I'm feeling a bit behind this morning, mate. Don't ask me why. We're seeing oil down.
Yeah.
I wouldn't call it risk on, but
No,
you know, because gold's still up. What is there anything behind that oil move?
Yeah, I think there's a bit going on the Venezuela side, even though that people will argue that it is not going to bring that much more oil onto the market. But shall we say that we are past the first speculation hump on the back of the Middle East? I know the dollar is bid across the board, right? But it does also feel, perhaps with this Venezuelan thing, and also later tonight, and that's going to be very late for us because I think it's around 8 p.m. Eastern time. Biden is about to speak.
Yeah.
And perhaps the market is like taking a breather in some of those instruments. We can see it in silver, gold as well. It's staying high, but especially silver has been correcting more than gold. But it seems that we are perhaps past the first speculation hump on the back of the Middle East, and then we will see what comes out of this Biden thing. He already said that he was supportive of what the Israelis wanted to do. So I don't expect huge news to come out, but perhaps there's going to be some subtleties in whatever packages they can put together for support, because I've seen he's going to ask for up to $100 billion or so support for Israel, which is, and another extra 60 for Ukraine. I don't know if there's going to be some, I'm going to say trade, but if there's going to be some moves behind that. That is rather what I see on this oil right now.
Yeah, thanks, mate. One bit of other news, well, not really news, but just something that we keep our finger on, a particular pulse. There was a poll out by Bloomberg and Morning Consult that had Trump leading in several key swing states. And it was a lot to do with voters really favouring Trump on economic message that over Biden. And so that's something that's come out in news. He's leading Biden in this poll, 47% to 43% among the voters in several places like Arizona, Georgia, Nevada, North Carolina, Wisconsin, so on and so on. So just, these polls are going to become more prevalent. They're probably not market moving right now, but they are going to be featuring more and more as we get into next year with the election coming up there as well. But yeah, just heads up, poll, Trump seems to be favoured in a lot of these polls. Yeah, that's where we'll leave it there. Not here to make any political comment. All we're looking at is the potential market impact from these things. So that's all. Yeah, mate.
It's not a political comment, but if ever the Orange Highness wins it again, we have to buy Twitter shares or X shares, because that's going to be the again.
Well, he's got his own one.
Not a political comment.
He's got his own one, Truth Social. So I don't know if he'll go back on Twitter or he'll just we'll have to buy shares in his one.
Yeah.
We'll be running over there to see see if he's dancing ahead of data again like he did last time. But yeah, anyway, let's wait and see on that front, eh? Yeah, you got anything else, mate, that's crossed your path?
Nothing really that is fresh news. It's just a bit laughable that all those it's rather weather vane strategists at banks or economics at banks still
You're gonna talk about forecast, aren't
changing
you?
opinion about rate hikes or cuts everywhere, or on the click of on one data point, that's a bit laughable. And it's you look at the Canada, for instance, it was enough that people were pricing out a bit of that Bank of Canada expectations to send the Canada percent a full percent weaker. So yeah, that's a bit it's a bit laughable still, but that's the kind of markets we're in right now, and that's what is moving the markets, and machines react to everything that they every word that they see, where banks are changing opinions and stuff.
Yeah, exactly. Right, so we have got some moves afoot. Obviously, the big headlines are coming around yields. US 10s made the break above the prior high, and now we're tapping on the 5% level, which is going to be pretty big. It's more, well, aside from what it's going to cost the Treasury, it's a big psychological level. We've already we run into a bit of trouble into it as natural. You can almost think of this as a big figure in dollar yen. This is like the 150 at the moment in dollar yen, this 5% level. If it breaks and busts higher, then we're going to be getting all sorts of headlines coming out about pressure on the US funding situation because of those increased costs. We know that they're increasing their supply of bonds that they want to sell because they need a lot of money to plug some holes. So that was already ongoing, and I think the supply is set to almost double, isn't it? Or indeed double next quarter, or this Q4. Okay.
Yeah, it's an ongoing thing, mate. It's just nonstop, and that's very dangerous for those yields and things. It's something that I've been talking about since the start of Q3, when the Treasury started to up their funding needs and bond issuances, and I've always said, like, be careful if you're looking for a top in yields, because this is going to create a lot of supply in the bond markets, and the market may not be ready to absorb it all. And now we're here, and now people are putting it on the back of the debt situation. But I think those bond issuances have a lot to do with the reasons why we are here, amongst other things like QT and stuff. Because I mean, if you're doing QT and at the same time your Treasury is increasing the bond issuances, there's not many directions yields could go, unless your economy goes down on the right, in which case it's going to weigh very heavily on the markets, and all the money parked at the Fed is probably going to rush into the bond market then. But the data tell us that we are not there yet, right?
Yeah, no, exactly. But some things like this, when you get a psychological break in yields, it does put the pressure on financing. It can create a bit of a doom loop, because then the market's increasing your costs when you do those auctions, and then you just ended up paying more and more and more, and that obviously affects your financial position. So it can be a bit of a negative snowball rolling. It depends how and when the market wants to go. Right, this is a real problem.
Exactly, and that should be in the end also reflected in equity markets. At some stage, it should really start to be reflected. The problem is as well, what I have, and then for us traders, especially FX traders, if you're not a bond trader or an equity trader, is what do you do with the dollar if those yields explode? We have seen that, okay, the dollar is stronger, but in some areas not so much. But the problem is also what do you do with the non-US dollar debt, because that's increased a lot over the pandemic, and that may create another issue. But then to the other side, if you trade dollars, if you think let's assume that you only have dollar holdings, US holdings of dollar debt, and you start to weigh on the economy. It would be a no-brainer. I mean, even if yields go higher, it's a big issue. Equities will go lower, and probably your dollar will come down. But if you take into account the non-US dollar debt, that's another issue. I've seen some updates coming through that the non-US dollar denominated debt stands around 30 or so % of all dollar outstanding, which is historically seen not high. That's historically seen not high. So we could argue that there would be less stress, but then you take into account the amounts, and you will see that the amount has gone up because there's just been an immense amount of dollars thrown into the market over the pandemic. So again, that's a bit of a double-edged sword. I think my personal view is still that if those yields continue to go higher, we are going to go into a very, very messy end of 2023. But
yeah,
it's not necessarily happening today, but keep an eye on what's happening starting mid-November also.
Yeah, and it's also important to look at it from the fundamental, the economic side of things as well. You know, government debt isn't income for the government, okay? Tax receipts are income for the government. So if you've got a fairly strong economy, then it stands to reason you're going to get tax receipts and stuff that, you know, go into the coffers. That's the profit for a government and treasury. Now, if you got yield running higher, you can sort of offset some of that increased cost because you've got a good economy. Okay, it's not a linear correlation, but it's there or thereabouts. Now, if your economy starts suffering, you're losing all that income because activity is dropping. Now the market's a bit fearful because yields are breaking up. They're demanding a premium over what you can borrow, and some stress comes in because the market says, well, hang on a minute, you're not earning as much as you were before, so we want to take a bit more premium on buying your debt. And that creates a bit of a stress on the economic side as well. So there's always, you know, it's multifaceted, shall we say, when you look at what happens and what yields can cause. It can cause a run into bonds, you know, if there's stresses seen in certain angles, but it can also cause yields to continue rising because investors demand a higher premium to give you their money. So it's never a straight line in these things, and we just have to judge what the pull and push is at any particular time. But just to give you a bit of insight into you know, all aspects and how things work, so we can hopefully judge what to make of any moves should they happen. But I think Kay's spot on. It's maybe a bit of a pinch time as we get into the latter part of the year. Right, so what's happening? Well, it's another mixed picture. You know, we've got these yields running high. You think the dollar would be, you know, clearing house all over the place. It's not. You know, dollar yen is still stuck in its quagmire. You know, having a little half-hearted look at up towards 150, but, you know, still very tight ranges and not really following what you might expect in yields. That could be the yen side keeping things in check. We've got euro dollar 20 pip range today so far. Let me just check. Yeah, 28 low, 48 high. So we're trading 20 pips there. Again, doing nothing while yields are still looking hot. Cable's looking a bit worse though, just had a move under 121. We've got euro sterling. I don't know if this is a bit of a stop run through the big figure here. That's what's causing cable to move lower, or vice versa. Cable moving lower is kicking this one up, but we are daring to dream, as I wrote in the chat room earlier. Are we going to get a move above this 15-20 area? At the moment, it's slammed right into it. This could be a bit of a kicker if it continues up. May mean that cable's going to suffer more. Potentially, there's going to be some decent stops above this area, I should think, and that a break there might accelerate us up to the mid towards the high 87s if it goes. If we do get a break here, I'm going to look to see if it finds it as support. I may look to add back into my core euro sterling longs here. I'm not so keen yet to get into a break trade on an initial break. I might just wait for that confirmation and see what happens. But yeah, Aussie dollar, that's getting a bit sucky. The euro seems top of the tree at the moment. Is that mainly cost driven at the moment in the euro? When you look at cable, Aussie, Kiwi.
Yeah. Yeah, I think it's euro. I think it's cross driven, mate. Yeah, when you look at the differentials, those euro differentials are not moving that much. And also, it's a tough one to talk about risk or just plain risk, but it is so that when the market rate risk off, the euro crosses have a tendency to move up. But it's been especially noted in stuff like the euro commods, the euro oils, the euro versus emerging market. That's where the euro is really getting its beat from. And I also think that the market, in the back of their mind, still saying like, yeah, okay, the ECB can still go and tighten somewhat. I mean, which is either with another 25 bps or with more QT. So I think that's a mix of stuff is now playing in the hands more of the euro crosses, and that is in my opinion what's holding up the euro dollar. It's also you can and as I've been saying that for quite a while, there is yield differentials but there's also a lot of stuff. So we don't only trade yields, right? Because otherwise there would be no market, basically, because you wouldn't find any dollar sellers because versus euro or any currency that has a lower interest rate than the US, and you won't find any any sellers in stuff like Mexican peso, for instance, because it's at an 11% interest rate. But that's why I'm saying, I mean, there's other factors in play, and I think now those other factors are showing in the euro, and that is slowing down euro dollar. We also cannot forget that the euro dollar is the biggest liquid market, right? It's the market with the highest liquidity. So de facto, that's a bigger obstacle to move out of the way. So whether it be up or down. So I think there's the main reasons why the euro is the euro dollar is quiet and the euro crosses are rather moving on the back of things.
Yeah, very much so, mate. As you can see there, we're talking about Kiwi. They've been bumping along the bottom on their support. Now it's at the break. It's gone through the intermediate levels. This trend line potentially a bit of a line in the sand here. Get a break there. It's maybe 55's bound all the way back down here. We'll probably get obviously some traffic at certain points, 57's, that sort of thing. But I still struggle at the moment to think that these sort of moves are fundamentally driven and not just as a consequence of what's happening in yields, US yields and the dollar. It all looks US driven. Would I be buying Kiwi over the dollar, over the US on the fundamental basis? Probably not, because there's no real difference. So I'm finding it a bit tough to, if this was just purely a fundamental move, I think, yeah, fine, great. But I don't think it is. I think there's other forces that are creating this move. So on that basis, I half don't trust them. But, we've got to trade something. We've got to trade it as we see it. So, if you're someone who's looking for longs, here's your risk point. You can trade off the 58 area, stop below 58. Don't need to risk a lot. And if it bounces, then off you go. But I'll be wary if you get a move back to this break area, 60, 70, and it starts holding. That would give an indication that shorts are probably the best strategy. So whether I believe the moves or not, I can always just rely on the levels. But hence why I was saying in something like euro sterling, any other time, if the euro was doing well and the UK was doing crap, I'll be potentially buying a break on that. But I wouldn't trust a break until I see it confirm. So there's plenty of ways to skin a cat, and we've also obviously got what's going on up here at 150. Do you reckon this is going to go soon, mate, or what's happening?
I'll have a quick look later on.
Yeah,
I think it's gonna go. But there's stuff. Oh, okay, all right. So this is the actual dollar-yen chart. So we are waiting for the reanimation crew to come in and liven this up again. Now, in all seriousness, I do think it's going to go, but I'm starting to more and more think that there is two things here. There is either somebody after the last blast up above 150 and the move lower. Either somebody has put a big barrier in place there and is defending it, or as some have suggested here as well, and which could have been the case. I'm still in doubt. But as some have suggested here as well, is that we see a bit of in China, I would call them easy, or the submarines leaning on stuff. But in Japan, yeah, there may be a bit of a postal action or somebody leaning. It's clear that with where the yields are now, it should have been above 150 already. There's no shadow of a doubt. I mean, it was up here when yields were 20 bps lower. So and since it's normally attached to or correlated to the US yields, it should have been above 150. So there's definitely something going on around here. I don't think it's only the fear of interventions. I don't think so. There are still buyers on dips of what I heard, but they are not getting any dips. So my base case is that we are going to blast through at one stage, and we could find ourselves somewhere more around 151. But we have Powell tonight as well in a few hours, in about 6 hours from now, and I'm going to look at this cable, and because we are on interesting levels there as well, right? We've seen, and we were saying about, okay, it's 121, 120.80 up to 123.20. It's still trading that, and we just tagged this 120.90 again, and we are moving up a little bit. So and I'm using the cable just as an example. My case for today is that the market may think that Powell is perhaps going to talk about something finally because of those yields going higher. Look at the 30s. We're well above 5% right now. The 10s are really there, and I think there's maybe a little bit of a case for a pause here in the dollar into the Powell speech. We have a bit of data out this afternoon. We have the Philly Fed. We have the usual claims, but the claims are just, in my opinion, an excuse. If the market is already moving in that direction, it doesn't change much unless we get like a really bad print of 280, 90K or so, and it doesn't seem that we are going to get that. But I could see a bit of a pause.
Have you seen anyone getting any? I've seen a couple of expectations for Powell that he may use this to say something. I'm not seeing any broad expectations for Powell. So what if he doesn't say anything? Are we going to see yields then finally take off, or
yes,
is the market waiting for him not to say anything before it carries on?
Yeah, well, I think it's actually pretty binary on what Powell is going to say later. So there's two things. Perhaps the market is waiting. Well, the market is certainly going to wait for Powell, because if he says something about financial conditions today, if he says something like in the lines of Harker saying that the market is doing their job right now, and they are, and he hints that at the fact that they may be done. Then we are going to see a reaction on the dollar, likely lower. But then we still have to wait what Biden is going to say now. And if Powell continues to walk his very fine lines, do his high wire walking, and doesn't say much, then yeah, I really think those yields are going to take off. I don't even know if I have it on weekly. Yeah, here. Then we may be looking at stuff before the GFC, right? Around 530%. I think it's just possible. I think really it is possible, and I also think that regardless of what Powell says, okay, it would already be a big move, okay, because now 488 was it the prior high. It should already be a little bit of support, but then if he succeeds to put it lower, are we really going to go below those 470-75 in the knowledge that later tonight either Biden is going to say, yeah, green light for Israel to go in, or and also then we are going to have these still those treasury auctions going on, right? So yeah, I think it's going to be a bit of a binary event for the FX on the dollar. We are, as you've shown already, on important levels in the Kiwi. We are on levels in the Aussie dollar. We are on levels. You see those levels in the Aussie dollar. It's really not far from here either. 62.75, 75.85. We are on the level there. We are in front of the psychological 150 in dollar yen. If Powell doesn't say anything, then I think there's going to be a lot of upward pressure on yields and on the dollar, really. But I do think that prior to it, the market may again hope that he may say something. So my case was today is that we've seen the dollar demand continuing from yesterday, the overnight. We've seen that dollar demand continuing, but I think we can correct just a little bit before Powell comes on. In the euro, it's going to be all about 105.70 in the short term, but that's too close by, in my opinion. So I still would think 105.95 figure, because we can have a bit of a fakey on a stop run ahead of Powell because of the euro holding up pretty well, and then just take the opposite side again after Powell. But again, as we've been showing, with the euro crosses being bid as they are, I'd say other currencies may be a better play. And then I'm thinking about stuff like the Aussie, the Kiwi, CAD as well to a certain extent, because that now has shown that the 137 is cleared again. We're again above this block here, and we're probably on our way to high 137s, providing Powell doesn't turn the dollar around completely. And Bran, I mean, you're asking about euro sterling. Ryan has been speaking about it for 10 minutes before. So euro sterling is done. It's all about this 87.15 2025. Okay. Yeah. So I'd say other dollars may be better than the euro to express the bullish feeling. And then I'm thinking about stuff here. The dollar Norway, for instance, euro NOK is ramping higher. As soon as oil turns around, those currencies who normally should be supported by oil and gas being higher, they just show more weakness. So that's your risk-off play, really. So keep an eye on what's happening. Dollar Norway 11, 16, 17 as well after Powell. Okay. We really have to go back below 11 here to turn it around for as long as we're above. And same happening for the MEX, same happening for the Rand. The Rand has broken up, in my opinion. I unfortunately let mine go yesterday, but I'm planning to have a look at what's happening after Powell around 1895, 1890-95 here. If we can get down there and ahead of Powell, that would be a nice one to trade off or stay away if Powell says something about the dollar. And that's it for me, Ryan. Back over to you.
Yeah, thank you very much, mate. Not really got much to add to that. As Kay mentioned, we got Philly Fed manufacturing index coming up. We'll get a second look at the picture there in the US and jobless claims. Expecting a little 3K lift to 212K, as long as it's nothing, too volatile either side of that. That should pass under the breach without a fuss. Yeah. Keep an eye on yields. I've said it before, keep that 10-year yield on your charts or open somewhere easy to hand, because it could be a bit of a decider what happens up there, be it before, after, over, Powell, bidden, whatever. Let that be your guide for everything else. And on that note, thank you very much for your attendance. You're a bit quiet the last couple of days, I've noticed in the chat here. So, let's get you talking a bit tomorrow, shall we? After we know what's happened with Powell and whatnot. We don't want to just hear our thoughts. We want to hear your thoughts as well. They're just as important to us as I hope our thoughts are to you. So let's hear you, guys and girls. Thank you, K-Man, for all your wonderful stuff as always, and we'll see you all tomorrow.
Have a good day, guys. Enjoy the rest of your day, Ryan.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.